Hi, Merry Christmas, everyone. My name is Kathlyn, founder and chief trainer from Beyond Insights. It is the year end right now and we are in a Christmas holiday mood. Are you interested to find out what exactly Santa Claus Rally is? Santa Claus Rally is a phenomenon in the stock market where price tends to rise near the year end. So why does it happen? There's no single agreed upon reason, but there are several factors that could explain this on a fundamental basis, right? First of all, at the year end, do you agree that more people will go out for shopping, more people will go for traveling, and they tend to buy more gifts for their friends? There's this holiday mood where people tend to spend more. Stock market goes up when consumer spending goes up, right? So when people spend more, companies can make more money and it justify the stock price to go up. On top of the mood of spending more money and also on vacation, the next one is about year-end bonus, right? Some companies pay the bonus in December, so when they pay in December, people have more money and they tend to use that for either contribution to the investment account, which I think that would be advisable rather than spending it on shopping. Yeah, you need to what we call pay yourself first. That means you need to invest in yourself. Either you go for education or you go for something that's good for your future or invest in something valuable for the long-term growth. So that's where sometimes people take their year-end bonus to invest, and that means more money in the stock market. Stock price goes up when there's more buyer than seller, right? That's a simple context. On top of that, in some countries, especially the US, by late December, a lot of investors would have want to sell some underperforming stock for tax loss harvesting, they call it. Yeah. So in the US, there's a taxation for investing and trading returns, right? They have to file. If there's a tax loss, right, they can actually use it to offset some subsequent years' gains as well. So by the time a lot of people would have already sell whatever they need to sell, then towards the year end, they can start thinking about what they want to buy for the subsequent year. Right, so this is also one of the reasons. There are actually other reasons that a lot of people may not know. One of it is called window dressing, right? A technical term that may not be so familiar. So have you heard about window shopping? Window shopping typically means you go for shopping but you don't buy anything. But this is very different. Window dressing is a term used where fund managers, at the end of the year, they want the portfolio to look good before they send out the year-end report to their clients. So how do they make the report look good? Is they have to sell off those non-performing stocks and they have to buy the great performing stocks so that by the year end, their portfolio shows that they have some great stocks, right? It shows that, wow, this manager actually are great at choosing the great stocks to invest. And because of that, the non-performing stocks will be performing worse and the great performing stocks will perform even better, right? So this is the term for windows dressing. So does the Christmas rally always happen? The answer is it's not always guaranteed. But in general, like this is statistics. Statistics means a higher probability of happening. About 70 to 80% of the time, if you take an average over 20 years, right, everything needs to be put in context to the particular year because there are macro events that could happen during the year. What if there's a war, right? That could change things. What if there's an election, right? It could also change things. For example, this year we have election and Donald Trump won and the rally started earlier. When a rally already started way early, there are chances that people may want to take profit before they go for holidays because they don't want to monitor their stock. For example, in 2022, let me show you this stock chart here. Right, we have the Federal Reserve raising interest rate aggressively, close to 5% interest rate hike in a year. So the stock market did not do well. Of course, during the December period, the stock market did not rally. Right, so that's what I mean by putting it in the context of what happened for that particular year. There are some years in December where the US hit with a debt ceiling, right, and resolved in January. Right? So during that particular year, the market also did not rally. So I've experienced that during the Obama time when Obama was the president. Why does it happen fundamentally rather than statistically? Fundamentally, it's because a lot of companies want to take advantage of the year-end holiday seasons where people are in a good mood to go for shopping and they tend to buy stuff during that time. So a lot of companies tend to announce new products during September, especially Apple, right? If you look at the past Apple announcement, they typically announce new products in September, especially the new iPhone or new gadgets, right? So when they announce around September, it triggers the more purchases during the year end. And this is just one company. If more companies does that, that means new product brings new revenue for companies and it justify for the stock price to go up. So bear in mind that it won't happen exactly the same, right? Those are statistics, but you cannot look at it like that because every year there's a different context affecting the market. But we will watch out and we look at the chart and we look at for the turning point, and that's where the entry exit rules is important, and you also need to make sure that you have a stop loss in case you're wrong. So how many of you think that it's worth understanding this and observing towards the year-end rally? So I hope you find this information useful, and I wish every one of you a great Merry Christmas. But before I close off, I'd like to share with you that Beyond Insights is organizing a symposium on January 18, right? You can click on the link below to find out more. This is a very, very important event where you'll be learning about the mega trends, right, in the upcoming year, and we have great speakers lining up for you. First of all, we have YTL coming in to talk about AI ecosystems, and they also will be launching the digital bank next year. On top of that, we have Google, right? We have the lead who is responsible for the Asian proliferations of the cloud computing to be speaking to you so you can understand more about the Google roadmap, right? And on top of that, we have a very special guest, which is 𝘧𝘪𝘴𝘐𝘪𝘴𝘵, right? 𝘧𝘪𝘴𝘵𝘴𝘐 is a clinical psychologist, but more importantly, how does it relate to investment and trading? He is a coach for hedge fund traders, and he coached elite traders, and he's going to be here. I will be having a Q&A interview with him via Zoom. The rest are all face-to-face except for 𝘧𝘪𝘴𝘴𝘐𝘪𝘴𝘵 because he's located in New York. We'll have a session where I'll be interviewing him on what makes great elite trader, right? What keeps them to very high performance, right? What are the secret sauce behind that? What is the routine like? Are you interested to find out, right? And of course, we have many more insights into China market. You know, a lot of stimulus is being announced. Is it time to invest in China market? Many people may, be wondering about that. Are you one of them? Yeah, so we have a special detailed coverage of that. Most important, at the end of the session, we'll also be sharing with you the market outlook for 2025, and also what are the risks and opportunities that you need to manage, right? We have a great lineup of panel of speakers, and I hope to see you there. Do click on the link below and register right now. If you enjoyed this video and find it useful, click on the like, and don't forget about clicking subscribe as well, so that you can enjoy more videos from us in the future. And we'll be adding more and more content that are useful to investors and traders.
But I want to qualify that this video was created before the FOMC meeting on Thursday, right? So you can see that the Federal Reserve Committee decided to cut interest rate 0.5% lower than expected for next year, and that caused a market correction. But on Friday itself, because the PCE inflation indicator, which is used by the Fed, was lower than expected, which means inflation is lower and the market rallied back. So these 2 days is not enough to have a stability for the market. So for the meantime, it's best for you to trade intraday first, or you can wait for the strong support, right, to stagger buy for those stocks that are not overvalued, right? Make sure that you do your due diligence, like based on what you have thought to. For those of you who have attended a class, and for the rest, make sure you build your competency, right? Not simply going to the market. Remember, it takes a couple of days to stabilize the market. But in general, for most of the year, like there's a year-end rally, probably 70 to 80% of the time. So do watch the video, and remember, put it in context. It doesn't happen every year. So this is my Christmas gift to you. Okay, see you again in next video.